Whenever a big financial crisis hits, it feels like the world just splits in two. For most people, it's nothing but fear, panic, and loss. But for a small group of investors, that exact same moment of chaos is the single greatest investment opportunity of the decade. So today, we're going to break down the framework that separates the fearful from the phenomenal. Let's dive in.
I mean, just look at this. On one hand, you've got headlines screaming, worst crisis since the 30s, total doom and gloom. But on the other hand, you see stories about legends like Warren Buffett making $10 billion from that very same crisis. It's the same event, but two completely different realities. So how is that even possible?
And that really gets us to the heart of this whole explainer. When you are smack in the middle of a market meltdown, what are you actually looking at? Is it a financial disaster or is it a once-in-a-decade opportunity? The answer, it turns out, really depends on the framework you're using.
Okay, so the core idea here is completely counterintuitive, and you got to wrap your head around this. The legendary investor Sir John Templeton famously said that the time to buy is when there's maximum pessimism. In other words, the exact moment when everyone else is freaking out, that is precisely your point of maximum opportunity.
And if you look back at history, one of the most rewarding places to be during these moments of panic is, believe it or not, the financial sector itself. I know, it sounds crazy, right? To invest in the very companies at the heart of the crisis, but the data is just incredibly compelling.
Need some proof? Let's take the 2008 global financial crisis. Let's say you invested in India's Bank Nifty Index, which is just a basket of the country's biggest banks. Even if you bought 3 months before the market hit its absolute rock bottom, you still would have made a 32% compound annual growth rate over the next 3 years. A 32% return year after year that absolutely crushed the rest of the market. It's just a stunning example of how you can turn pure panic in a massive profit.
So how do you actually build the courage to buy when everyone else is selling their shoes? Well, it starts with understanding that these crises, they aren't some random, once-in-a-lifetime event. They are part of a predictable, recurring pattern, the cycle of boom and bust. And historical data just illustrates this pattern beautifully. If you look at Indian credit cycles over the decades, you see this clear rhythm. There's a boom, then a crisis, which is always followed by a recovery, and then another boom. The key takeaway here is that no matter how bleak it looks in the middle of a bust, a recovery phase has always followed. It's practically inevitable. This is one of my all-time favorite quotes in finance, from the authors of a book literally called "This Time is Different." It's just such a powerful reminder that while the little details of each crisis might change, the underlying human behaviors, fear, greed, and the economic patterns of boom and bust, they just tend to repeat themselves over and over again.
Okay, but, and this is a huge but, here's the catch. Just because the whole sector recovers, that doesn't mean every single company does. A crisis is like a massive stress test. It exposes all the weak spots and rewards the companies that are built to last. So, the billion-dollar question becomes, how on earth do you find the companies that won't just survive the storm, but will actually come out of it stronger than ever?
The answer isn't about guessing or trying to perfectly time the bottom of the market. It's about having a disciplined, almost scientific process. It's about having a system to filter out all the noise and identify the true financial superstars.
And this investment funnel shows you exactly how it's done. You start with the whole universe of financial companies. The first, and honestly the most critical filter, is a forensic accounting screen. This is what weeds out the companies with sketchy books. From there, you dig into how well they allocate their capital, you talk to people on the ground, and you meet with the management team. What you're left with at the end is a small, concentrated portfolio of the absolute best of the best.
Now, that term, forensic accounting, I know it might sound complicated, but the idea is actually super simple. It's all about using a specific set of financial ratios to basically act like a detective. You're looking for clues of hidden problems, sneaky accounting tricks, or just plain poor quality bookkeeping. It is the single most powerful tool for avoiding a complete disaster. All right, so let's put this theory to the test. We're going to look at 2 real-world case studies from a recent crisis in India. One is a clear winner, and the other, well, it was a company whose red flags were waving long before it finally collapsed.
First up, the winner, HDFC Bank. I mean, the data on their performance is just remarkable. They consistently show lower non-performing assets, that's just banker speak for bad loans, and much higher returns than their competitors. And this isn't luck. It's the result of a relentless focus on process, super conservative lending, and actually learning from what went wrong with other banks. They built a financial fortress that could withstand any storm, which is why they come out stronger after every single crisis.
Now, let's look at the loser, DHFL. What's so fascinating here is that a forensic accounting model flagged this company as super high risk years before it went down. Just look at the red flags on this slide. Its fee income was suspiciously high. That can be a sign a company is pulling future profits into the present just to make the numbers look good now. Its non-core income was also way too high, a classic sign of low quality. And a key ratio, change in reserves, was way off, which hinted that they were hiding expenses on the balance sheet. These weren't subtle hints, these were clear warnings.
Look, buying right is only half the battle. A truly great strategy also knows exactly when it's time to get out. You can't just ride the wave up forever. You need clear, unemotional signals to tell you when the party is probably about to end.
So the trick is to have a checklist, and here are 3 really powerful sell signals. Number 1, you're about 3 or 4 years past the crisis and the economy is just roaring again. Number 2, you see a flood of IPOs, initial public offerings. That's a classic sign the market is getting frothy because everyone's rushing to sell shares to an overexcited public. And number 3, this one's a bit more technical. The gap between what companies pay to borrow money and what the government pays gets super tight. That means investors are getting complacent and aren't demanding to be paid for taking on more risk. And you can see that last signal in action right here. For example, back in 2007 and then again in 2010, that credit spread totally bottomed out. And both times, it was a perfect warning sign to sell right before a major market downturn. See, it's not about having a crystal ball, it's just about recognizing historical patterns that tell you when risk is getting way too high.
So we end right back where we started. Another crisis will come. It's not a question of if, but when. There will be panic. There will be scary headlines. The only question is, what will you see? Will you see the danger that everyone else is focused on? Or will you see the once-in-a-decade opportunity? Because now you're armed with a framework to find the superstars hidden in the wreckage.